All right, I'm just going to quickly review the market here and show some wave volume patterns as well, because wave volume is really good. In terms of finding trend reversals. I don't know why it's so good, but well, actually I do. It has to do with it accurately measuring supply and demand. So anyway, long story short, let's just go through this. Okay, so let's delete all this shit. Maybe I'll just. Alright. So it goes down here, it breaks. Here, you see this pullback? There's a 3-minute pullback. This activity increased. Activity and volume is almost the same, but they're actually different. Their meaning is the same, meaning they gave the same picture, but they're actually totally different. Okay, volume is volume and activity is activity, and I'm not going to get into the details, but the point is that you can use activity like you use volume, and volume like you use activity, and on an intraday basis, it's activity is, I think, the key factor, because volume intraday on the bars is very weird. The whole premise behind wave volume is that volume cannot be time sliced. That volume, when you slice it by time, like 5-minute bars or 4-minute or 3-minute bars or 1-minute bars, you lose the force of the buying and selling. And therefore, wave volume solves that problem, because price movement unveils itself in waves, or supply and demand unveils itself in waves, etc., etc. So that the whole point of why wave volume was created, wave volume, Weiss wave, or whatever you want to call it, is because volume on the bar is not telling. It loses, you lose the ability to read the force of the supply and demand, and therefore you have wave volume. But there's actually another way to do it, which I got. 1 second. Stop. All right. Okay. Anyway, over here, you see selling, you see buying. This right here, this little 5 here. You see that? That's very important. That right there is actually a climax on a lower time frame, or you can consider it a minor climax. And yes, that is a Wyckoff behavior of finding minor climaxes on pullbacks. Not just climaxes, selling, buying climaxes on the end of trends, but minor climaxes on the end of pullbacks, as well as rally tops and bottoms. So that's the minor climax, and that's the breakdown. And that tells you lower prices are going to come. And they did. Here you had also, it was like a breakdown, but as you know, sometimes the market goes back, pulls back a little bit more in order to shake out stops and then go lower. And that's what it did. So you had a false breakout, or like a minor breakout. And that's also important. So right there is your minor breakout, the 13. That's actually a breakout, and then it goes up here. Here it gets very interesting, and I really like this movement where it goes sideways with the doji. First of all, you need to understand that doji, I know that's considered indecision or something like that, but here in terms of Wyckoff, he doesn't use the word doji. What he would refer to this is the lack of activity, possibly a halting point or something like that, or the end of distribution. When you have small range bars, that are clustered closes, the way to interpret that, and without using any terms, is that the force of that buying or selling has diminished. So even though you have a breakout here, when it comes up here and you have no thrust, you have sideways movement like that for 1, 2, 3, 4 bars, what does that mean? That means the force of the buying is exhausted. That's what it means. It's done. It's gone. It's finished. And then after that, you have this little pop right here. So that's like your minor climax. And then you have your reversal on increased activity, which goes a little bit lower. Here, I didn't really understand this behavior over here, because the problem here is this. Look at, you see, when you're judging price and volume, right? When you're judging waves, you have to think about three things. Every force, a force, meaning the force of supply and demand, or just force in general, has three components. One is its direction, and at least in supply and demand, obviously you have direction. Two is magnitude, right, which can be measured by volume. And three is gain, like what are you gaining, right? So this three things, when you consider waves, you have, these are three things that are running through your head. So and in a way you want to ask the question, what did we get for it? There was a whole lot of volume, but what did we get for it? Now, when you ask that question of what did we get for it, it means from high to high or low to low. So if I say, oh, you know, there's 1 million shares traded, the natural subsequent question should be, what did we get for that 1 million shares that was traded? How much price movement? If there is none, there's a problem. So in here, if I told you 115,000 shares were traded, 115,000 shares, and look at the low to low. Is there any progress? Is there any progress? The question is, how much was traded? How much was spent? How much did supply spend? 115,000. What is the next question? What did we get for it? You know what you got for it? Almost nothing. So this is your spring. At least over here is your spring, or your shortening of the thrust, or whatever you want to call it. It's like in a spring position or shortening of the thrust or whatever. All right. Now, yes, it had a selling over here, but it tapped, and again it goes down, and it's a decreasing volume. So something is not right, and that's what sets up demand. Because what this is saying is supply exhausted itself, bringing it from the upthrust high all the way down to support. It exhausted itself. And when it tried again, you could prove that it exhausted itself because it's less than half the volume, and it can't. It just goes down again and makes no progress from low to low. So what did we get for it? And the answer is, again, almost nothing. So when you're looking at waves, you're looking at direction, obviously, up a wave or down wave. You're asking, well, you know, the magnitude is just the volume. You can use volume. There's other things you can use as well, other measures. I'm not don't want to get too much into that, but volume is one. All right, and the third is the amount of gain, and that naturally begs the two questions. One, how much did we spend, and what did we get for it? So supply spent about 115,000 shares, and what did they get for it? Nothing. And that's telling you, there's going to be a reversal, because it cannot go any lower. It's too hard to go lower. That's what it's saying. It's just too hard to go lower. The ease of movement on the downside has evaporated, or is diminished, or it's easier to go up than it is down. Why? Because 115,000 shares and you're not getting anything means what? It's easier to go the other way. And that's what happens. So you'll see here 51,000 shares and 10 and whatever. So this was your change of behavior, and that set up the low volume pullbacks right here and here. Over here it tried to go down and it failed, and instead it reversed on more activity than the pressure that came in on the downside. So after that, after there's more activity on the upside, you know, it means that demand is taking over supply. It's overtaking supply. Where did demand overtake supply? Right here. Right here, the bulls overtook the bears. It tried to go down, they reversed it and went up. Tap, tap, break, go higher. As it goes higher, you know, it breaks out here and it goes higher. Then selling pressure again comes in against this low on increased activity. Down, breaks this low on increased activity, and you come up, 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 up. Right here is the climax. Right here is the reversal. That short can be taken. Why? It's against the breakdown. You have 1, 2, up thrust position, climactic activity, has no follow through, instead has a reversal. The 13 after that is making me think, oh, I don't know, it might go up, but in this case, it didn't. And it went down and down and down until the end of the day. So really, the trade was against this breakdown. You have your climactic action and you have your reversal. So this is the test of the breakdown and selling pressure, and it goes down. So that can be taken. And this is end of day short covering, so there's nothing really to be said about that. So what are the lessons here? So the first lesson is the ability to identify the minor climax on the pullback. If there's no minor climax on the pullback, you really want to reconsider taking the short. Why? Because if you have a one bar stop, right, then you should have a minor climax, because the minor climax will serve as resistance to the price going higher and running your stop. See this 5 over here? So this 5 is a minor climax. That minor climax, once it's taken down, once it's taken out, meaning it has to be taken out, it's like trapped. They're trapped, or I don't know how else to explain it, but it will serve as resistance, because if the price goes back there, it will either need to be absorbed or there would be some type of covering. So you have to ask yourself, how come it went up on increased activity and then went sideways and reversed back down? If it's a CM, then they will hold the position. They will not break. Buying up and then breaking down, that's not smart, right? Anyway, so there's the break. The second thing to understand here is that when you have breakdowns, you will get tests. Okay, right here, what do you have? You have a breakdown, you have a test, you have another climax right here, and you have a reversal. So that's the second thing. The third thing is this type of behavior, sideways range of small bars. It has to be both small bars and clustered closes or dojis, however you want to call it. They represent the end of a move, end of a phase actually. So many times in the end of distribution or accumulation, you'll have something like this. That even on a point and figure, you would have, like, you know, the one box reversals, bunch of them. They look like a horizontal XO columns of XO. And anyway, so here's the reversal, goes down. All right, the fourth thing is, how much did we get for it? So the question is, how much was spent and how much did we get for it? So over here, I can tell you that 76,000 was spent. How much did you get for it? You got a little bit of a high, right? All the way back down, 115,000 was spent. What did you get for it? Shit, you didn't get nothing. After that, another 49,000. What did you get for it? You got nothing. So what happens? It reverses. Why? Because you're not getting anything from the downside. The bulls are going to step in because they cannot go any lower. This is right here, 27 minutes, and it's not doing anything. So 115,000 shares cannot do much more damage than 76,000 shares on the upside. It's almost as big as the 76,000 share up wave. After that, tap, and then reverse. Here you have the springboard right there. That's your springboard. That's your springboard. This is the springboard behavior that Wyckoff said. The real Wyckoff trade, the real one, like the setup, if you want to call it that, is not a spring. It's not an upthrust, although both work. Like springs and upthrusts are in the repertoire because they're tests and they can definitely be traded, and they are traded. I mean, because they offer excellent opportunities. But what did Wyckoff say in his course? What did he say? What to trade? He said very clearly, trade springboards. Where's the nothing. 51 on the way up, only 10,000 on the way down. What happens? Pop. All right, now here's the thing. Springboard will initiate markup or markdown, right? Now it's an entirely separate thing to say how far the markup will go or how far the markdown will go. That's entirely separate, because when you have a springboard and you have a turning point, that turning point will set up a trend, but you don't know if that trend is part of the major trend or it's just a pullback. It's just a little fluctuation, meaning it's just a little turning point with a little trend, which is just maybe a test, or is it continuation of a trend? In this case, it's a test. How do you know? Just look at a higher time frame and you'll know that there's nothing more than a test. After that, what happens? All right, after it tests, the sellers come in, they break again here. Now what do you have? You have a test 1, now you have test 2, you have a minor climax, which I'm saying in my book is required. You should also have a lack of activity and then a reversal. You have some degree of a lack of activity and then a reversal here, and it goes down. And that is your trade of the day. So it's a little bit later, around 1:33, but that really was the move. Before that, in the morning, it sucked. So, I mean, in the morning, you had very little, you didn't really have much. I mean, you had this pullback, break, gives you very little movement, then come back to test, and you only had one wave. You didn't really, the test of the breakdown giving you one leg. Here, you had tap, tap, and yes, it's one leg, but it's pretty big. Very nice move. You have a breakdown, you have a test, you have your, you can call it doji or whatever, lack of activity, you have a climactic action, you have your reversal, and that is the short. Stop is above the breakout high. This is an upthrust, by the way, and it goes down. How do you know to get out? I don't want to get into all that, but you go down, up, down. Is there any volume? Cannot tell here, over here. The last down wave lasts only 3 minutes. That's a problem. What else? The upside activity starts increasing. How do you know? The indication right here. There's the most amount of activity in 7 bars. What does that mean? It's a green bar. It's going to go higher. How much higher? I don't know. What is it doing? Looks like it's testing. And we might be on a springboard again here. But it's short covering end of day, so can't really say much. All right, so that's a key thing. Is there anything else that was a key indication of the weakness that initiated the down wave? Yes, there was. What was it? Now pay attention. From a time perspective, the wave only lasted 6 minutes. That's really bad. That means there's no sun pressure from a time perspective, okay? The second thing from a volume perspective is take a look at this. 32, 23, 10. Is it increasing or decreasing? If you said that from 32 to 23 and to 10 is decreasing, then you're right, because that is your lack of demand. That is your lack of demand. That's your lack of demand that's telling you the demand is spent, it's going to reverse, and it's going to break down. Because there's no buying pressure, and that is a clear indication that there's no buying pressure, and in the background you have what? Selling pressure. Biggest in the last 10 waves. So they're not going to make it. All right. Now, the other thing, I want to show the same pattern right here where you have 32, 23, and 10, lack of demand. You see this rally over here? Now watch the same pattern here. Okay, let's go with that 115, right? 115, 49, 31, and 10. Can you see, what is the clear as day indication here? The clear as day indication here is that this is a lack of supply, because 115 to 49 to 31 to 10 is a obvious lack of supply. It keeps on decreasing on the down waves. What does that mean? It means it's going to go the other way. How far? That's a different question. Okay. What we do know is that 115, 49, 31, get out. Why? Because it's going to reverse. But how would you know to look for this? And I explained like 100 times that you don't just compare demand to supply. A lot of folks, what they'll do is say, oh, 24 is less than 31. So doesn't that okay mean that it's going down? Or they'll say 15 is less than 49. Doesn't that mean that it's going down? Because the down wave is greater than the up wave? This is the wrong way of reading wave volume. Because, as I explained before, you have to compare supply to supply to supply, demand to demand to demand, and then you can compare supply versus demand. So this is the error that a lot of people make. And when you compare supply to supply to supply, you'll notice that over the course of multiple waves, in this case 3 or 4, supply is decreasing. Boom. Same thing here. If you compare demand to supply first, you would say, oh, 32 is greater than 17. Shouldn't it go up? Or you might say 23 is greater than 10. Shouldn't it go up? But in this case, you're supposed to compare demand to demand to demand before you compare demand to supply. If you compare demand to supply, you'll say, oh, 32 is greater than 17 and 23 is greater than 10. It's going up. But what you would fail to do is see the relationship from demand to demand to demand and notice that it is decreasing. So even with the right data, you have to be skilled enough to know how to read wave volume or whatever tool you're using correctly. The intricacies of how to read it. So there's 3 ways of reading it. It's supply to supply, demand to demand, and then supply to demand. What do you do first? You compare supply to supply and demand to demand. Then, after that, you can compare supply to demand. Do not compare supply to demand first because it will give you the wrong picture. You must compare supply to supply and then demand to demand, and after that supply to demand. Now this is my opinion, but I believe that this gives you a more accurate it will give you more accurate judgment. Right? I mean, some people will compare supply to demand, and only that. If you do that, then you have to also do supply to supply and demand after that to get that. All 3 things have to be done, meaning supply to supply, demand to demand, and supply to demand. But what reading wave volume? That's what needs to be done. All right. Long story short. So the question is, what are you going to do on the pullbacks after a rally? After a rally, what you want to do on pullbacks is compare the pullback volume. So in this case, you compare demand, 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 pullback, 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 and you'll see it. Here, you compare after that shortening of the thrust, supply, 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 and you see it. And I mean, that's about it. Especially at the lows, at support and resistance areas. That's what you want to do. Let's mark it up. So let's see, lack of. So I don't know if I can mark it. Right. And this is very key, this setting up this springboard. Boom. And all right, folks, have a wonderful day. Bye.